Doji candlestick. A doji candlestick looks like a cross or plus sign on the chart. It is formed when the opening and closing prices are nearly or exactly the same. This results in a very small or non-existent real body. A doji primarily represents indecision in the market. Neither buyers nor sellers are in full control, and it signals a potential pause or reversal in the current trend. The example above shows how the market changed direction after the formation of a doji candlestick. Initially, the market was trending upward, with buyers firmly in control. But then a doji appears, signaling that buyers are starting to lose strength. The doji forms when the price opens and closes at nearly the same level. This means that although buyers tried to push the price higher, sellers stepped in and pushed it back down, creating a balance or indecision between both sides. This indecision often acts as a warning sign of a potential trend reversal, especially when it appears at the top or bottom of a trend. A doji suggests that the prior trend is weakening. Dojis can also appear during resting periods after strong price moves, hinting that the market is pausing before deciding its next direction. Always confirm the doji with the next candle and broader market context before taking action. A doji is a neutral candlestick that represents indecision in the market. It forms when buyers and sellers are equally matched at the time the candle is formed. As a result, the price opens and closes at nearly the same level, meaning the market goes nowhere despite the tug-of-war between bulls and bears. This struggle shows that neither side is in control, making the doji a signal of potential trend pause or reversal, especially when it appears after a strong price move. Dragonfly doji. Variation of the doji candlestick. A dragonfly doji is a type of doji candlestick that forms when the open high and close prices are all near the same level, but there's a long lower wick. This pattern forms when the price opens, then sellers push it lower, but buyers step in and drive the price all the way back up, closing near or at the opening level. The result is a candle with a long lower wick and little to no upper wick. The long lower tail shows that buyers strongly rejected lower prices, indicating their attempt to gain control and push the market upward. It is considered a bullish reversal pattern, especially when it appears at the bottom of a downtrend or near a key support level. This is how a dragonfly doji looks like on the chart. It has a long lower shadow with little to no upper wick, and the open and close prices are nearly the same, right at the top of the candle. This formation tells us that sellers pushed the price down, but buyers stepped in strongly, driving the price back up to the opening level. The result? A powerful sign of buying pressure and a potential bullish reversal, especially when it appears near a support level. The gravestone doji is formed when the price opens and buyers initially push the price higher. However, sellers step in and gain control, pushing the price back down toward the opening level. By the end of the session, the candle closes at or near the same level as the open. This candlestick has a long upper wick and little to no real body or lower wick, which indicates that buyers were rejected at higher prices. The long upper wick shows that sellers are refusing to let the price go higher, demonstrating strong selling pressure. It is considered a bearish candlestick pattern, especially when it appears after an uptrend or near a resistance level, suggesting a potential trend reversal to the downside. This is an example of a gravestone doji candlestick. When it forms at the resistance level, it signals a strong rejection from that area. Initially, buyers try to push the price up, but sellers step in with force, driving the price back down. The result? A long upper wick and a close near the opening price. This shows high selling pressure, suggesting that the price may reverse from here. Important points. A doji by itself is not a buy or sell signal. It simply shows indecision in the market. Always combine with other technical tools like support and resistance levels, trend lines, moving averages, or volume. Location matters. A doji at key support or resistance levels carries more weight. For example, at support may indicate potential bullish reversal. At resistance may signal bearish reversal. Volume adds clarity. High volume during the doji suggests stronger indecision and upcoming volatility. Low volume dojis may be less significant.